The number of homes for sale nationally is up 27.5%. And the question is, should you be concerned? Because that is 16 months of growth.
I know. I don't think you should be concerned.
Mm-hmm.
We're still severely under the historical average.
Right.
Right. So the listings are still way down, right? What's normal? And what's normal is 4 to 6 months on the market, days on market. That's normal. That's a normal market, year over year over year. We've just been spoiled. Like, I guess it's not good if you're trying to buy because prices are, they're not really dipping.
Well, let's look though. Let's dig into it because different parts of the country are really different. And Jerry, can you pull up the Fred reporting? This is going to go homes on market. And right now, there are 847,000 homes on market. But Jerry, if you go to January of 2020.
Yeah, take a look at that.
You'll see there, I don't know if it's showing, but it'll be 951,000.
So, by the way, that wasn't very long ago, if you really take a look at that. So you could see how it's gone down. It went down significantly from that point.
Yeah, so basically it went down significantly. So pre-pandemic, you could say we were at 951,000. Right now we're at 847,000. But if you go to November, Jerry, of last year, so pretty recent, you're going to see that 2024.
Yep, one more year there. There you go, Jerry.
You're going to see that it's at 952,000. So that is actually higher than it was in January of 2020. So basically from November until now, we're actually down almost 100,000 or over 100,000 homes. So the inventories actually went down since December.
Yeah, right. And obviously, the interesting thing is that the federal funds rate went down a little bit too.
It did.
Yeah.
Yep.
So listings went down and the rates went down a little. One really interesting bright spot, I think, is obviously if you go back here and you look at that little sliver there, that's kind of the pandemic, I guess, the recession. That's the shaded area there. If you take a look at what's happened since then, we had a fair amount of interest rate growth during that period of time. Mm-hmm. And so it should not surprise you that listings are going down when interest rates are low, right? Because people are refining, they're taking cash out, they're doing all that stuff. And that period of time, a lot of people were locked in at these 3 and 4% rates.
Yeah, absolutely.
And could you put that back up, Jerry? And so what you have is you have this trapped equity there, right? Mm-hmm. And don't forget, there was a significant amount of home price growth during that period of time.
Yeah.
So you have low rates and you have a lot of equity. And so what's starting to happen now is obviously as people have some of these financial issues, they're starting to churn some of that. We're hearing people are moving out of these really, I think some of those mortgages are so low, but they need the cash. They're scooping out of the cash,
or they have to move,
and they can't do a cash out refi, or they're moving, right? Mm-hmm. And so it's been very, very interesting, and that is the reason why it's the interest rates. If you have a 3 or 4% rate, just like you do on some of your investments, you are not going to sell.
Right.
The asset, the debt itself is an asset. And so that's actually what was created during this period of time. It's the people have a lot of equity, but they don't want to tap into it because they have such a low payment.
But we have to look at the numbers because it's 27.5% nationally. But if you look at the West, we saw listings grow in the West 37.4%. 29.9% in the South, 18.7% in the Midwest, and 9.2% in the Northeast. And just to kind of put that in perspective, pre-COVID levels, we're only down by 7% in the South, 9% in the West, 45% in the Midwest, and 58.4% 4% in the Northeast. So you could argue that the West Coast, our inventory is about what it was pre-pandemic levels. And the South is pretty close too. But then you look at the Midwest and the Northeast, and they're way below, pre-pandemic levels. And that's why sometimes when we talk on here and we say, the housing market's starting to level off, people, in Connecticut will say, no, my housing market's still on fire, et cetera, et cetera. It's because, real estate is local, it's not national. And so we even have a few metros where the inventory is above pre-pandemic levels, like Dallas, San Antonio, and Denver. So when you look at those things, you have to realize that every market's just a little bit different.
Right. And I think a lot of people do understand that. I think the inflation rate that came out this week is going to bode really, really well from a real estate standpoint. There's a couple things. We just had our mastermind call yesterday with the collective. You guys might know I have a mastermind that we meet 4 times a year with my partners, George Gammon, Jason Hartman, Russ Gray, and Robert Helms are my partners in that. And we have about 40 members. And we had this call yesterday with the 1031 guy, Scott Saunders. And he was saying that at any given time, he's moving $1 billion a month through their 1031 exchange. That's a lot of money, $1 billion a month. And so the question was 2 questions. One, what's Trump going to do with these tax policies? And of course, I know we talk about inflation. I'm going to get there. That's the first thing. And the second one is where's the money going? And that's an important topic. Where's the money going? And
what do you mean money?
Well, just exactly what I was just talking about, the 1031 money. So in Scott's scenario, most of that money is staying off of the coasts. So a lot of the money is going into more affordable Midwest. And I'm talking about a lot of this is commercial, of course, but some of it isn't. Some of it's just 1031 money. The other thing is, from a tax policy standpoint, he was saying that Memorial Day, which is in May, right, Jerry? Memorial Day, that's when Trump's going to roll out his tax plan for real estate, and it's going to be a pretty robust. And there's all kinds of stuff around on this. In fact, I got a really, really cool thing on it yesterday. I'm happy to post it. And so now with these low inflation figures that we've got, because don't forget, the reason that the Fed has cut rates or grown rates or increased rates is because of unemployment and, of course, inflation. And if you look at their mandate on their website, it's 2%. And so those numbers that came in yesterday, Jerry, were good. And I think that we could see some slight rate cuts, which would really, really help some of this stuff. The problem with it, of course, is rate cuts do create bubbles, and they potentially can create, consumption, and they could potentially create people buying more stuff, depending on how far they go.
Yeah, they say that every 1% rates are cut brings 1 million additional buyers into that market.
Yeah. So now, I don't know. Obviously, I think that bodes well for this administration. It certainly it gets the Fed down closer to their target, and which is 2% right now. And so I think that this is all a really, really good thing.
Yeah, absolutely. And if you...
Oh, there it is. Yeah, there it is. There's your inflation numbers, guys. And so the interesting thing is you guys know how high it was. But this is where we kind of landed. And that, what is it, 2.8, I think, roughly? 2.8, yeah. So, okay. So there it is. Okay, great. So let's take a look at that. Obviously, under the Biden administration, it went up quite a bit, up into the 9.1. This is when we started to see the rates go up, right? As you start to, I can't remember how many rate cuts, but there were a lot. There were a lot of rate cuts during this, in the early, let's say 2020, 2021, and then when we hit 9.1, they started to put these rate increases in place. And if you remember, they were like 3/4 of a point at a time. There were 3 in a row that were 3/4 of a point at a time. So that was over 2 points. And then all of a sudden came all the way back down. The interesting issue is when Biden took office and when he left office, the inflation rate was about the same.
Yeah.
But it peaked at 9 during his administration. And so this is going to be a really interesting factor, I think, moving forward. If we can get those inflation rate down, I think we could see some rate cuts.
So let's look at home prices, because this was actually very interesting, and this was from realtor.com for February. So it says home prices are down right now 0.8% on what has sold. However, a lot of that has to do with a lot of small homes being sold in the market, because the price per square foot is actually up 1.2%. So basically, you're having a lot more smaller homes sold than the larger ones, right? So people have to look at that, because you have to look at the data, and the data is supporting that home prices really aren't going down overall.
Right.
If anything, they're about flat. Newly listed homes are up 4.2% from last year. Sellers are cutting prices, 17% of sellers versus 14% of last year. Days on market are 66, and that's 5 more days than last year. So we're not seeing these significant changes. Everyone, we talked about this last week. Everyone wants a crash. Everyone's saying there's all these indicators. We're just not seeing it. 5 additional days on the market, inventory being up, prices being flat or up. I mean, you're just not seeing.
Those aren't big moves.
Prices going down.
Those aren't big changes at all.
No.
Yeah, I think the one big factor is the Doge stuff. And we did a really good interview with Todd Sachs up there. He's in the Northeast. Listings doubled. House prices went down 100,000 in that particular area as a result of a lot of the federal workers being displaced. That is going to continue through this year, but it's going to be spotty. Depending on how heavy, where you are, if you're investing or whether you own in an area, you could see some disruption there as people list their homes and move or whatever choices they make, for sure. But overall, I think it's going to be a pretty big number, but it's going to be scattered all over the place.
Yeah. And that is something, that to look at is how the economy is doing, right? If we start to see more job cuts, you're going to have less buyers. But if rates go down, you also have more buyers,
Correct.
And
refinances. Yeah,
and refinances, right. And so, and you're also seeing, this, these rates, kind of like the inflation numbers could really affect the rates. And the rates weren't supposed to go down much this year, but if inflation comes down, the Fed may lower rates, especially if the job numbers aren't as strong.
And I also think there has to be a pent-up demand of people that are sitting on homes that, like you even, that have a low rate and want to move that money into something else, right? Yeah. And so if rates come down, which these inflation numbers are positive, then you will now be in a position to maybe look at moving that money, right? How do you move that money to something else and still cash flow?
Well, and I think something else we can't not bring up is tariffs, right? Because Trump keeps, as of today, I think the tariffs are on. They keep going on and off and on and off. But, these tariffs are going to bring an increase to building a home.
Inflation, yeah.
Yeah. And, Jerry, if you can pull clip 1. It said, before the tariffs were announced, we expected building material prices to rise 3% due to normal market conditions. With the new tariffs, this increase could reach 10%.
Yeah. And
then if Jerry, can you pull clip 2? As a result of construction, costs could increase by 4% to 6% over the next 12 months, adding roughly $17,000 to $22,000 to the sticker prices of new homes. So this is going to, if this happens, this is going to affect the market.
That's a good point. So there's a couple things to also watch here. The first thing is if you own something, this is good for you. Mm-hmm. If you own hard assets, this is good for you. Not that you want the price of brand new homes to go up, but if it does and you own something, this is kind of the point of buying a hard asset. This is good for you. If you're in the custom home or single family home business, which by the way is where most of the activity has been, this is not good because those are going to be passed on to the consumer. The home builders are not going to eat those numbers. they're going to pass it on in the form of a price increase. And of course, maybe buy down the rate or do whatever they have to do to get the person in.
Yeah, or they're just not going to be able to pass it on, so they're just not going to build.
That could be too. I know, when rates went up a lot and prices went up for us during the pandemic, we pulled back on the new construction that we're doing. However, we are moving forward on new construction ourselves. And we're bracing ourselves for drywall, which is coming out of Mexico, or lumber, which is coming out of Canada, or some of the other components, and those are two dimension that could very possibly drive costs up for us for sure. But we're still going to move forward, and incrementally, even though it's a lot. It all boils down to the math of the operating expenses of the property, the debt that you actually get, and the rent. So, those things all being equal, we will take a little bit of a hit personally on the return. But, again, it just boils down to the math.
Yeah, and I think that it's good to point out right now that everyone has been waiting for this buyer's market. And I don't want buyers to really miss out, because right now is actually a good time to buy because inventory's up and because you can negotiate with sellers. I mean, sellers right now are negotiating.
They are, yeah.
They are, because their homes are sitting longer. Does that mean they're just going to sit there and take no money for it and prices are going to crash? Like, no, it's not. The housing market isn't always just like shooting up or shooting down. Like what we saw the last few years was kind of this crazy shoot up in prices because of COVID, supply and demand, stimulus money, all these things. But now, the market is turning a little bit into a buyer's market.
Well, let's talk about that. So we just bought a house in December, and the guy lowered prices 5 times in about a 10-month period. 5 times, by the way. Danille's looking at an investment right now in a neighborhood that she's kind of got her eye on and targeted, and you own 2 or 3 there now, and there's 5 listed, right?
Yeah.
5 listed in that neighborhood, which, by the way, in the last 5 years, we haven't seen that many.
No, we've seen like one at a time.
One at a time. It's a tough neighborhood to find deals in because I think it's a phenomenal market to be able to buy a rental house in. It's a house with 2-car garage and single level and all that. And anyway, there's 5 available. So what's going to happen is she's actually positioning right now to be able to go negotiate on one of those 5.
Right. I'm trying to sell my place so then I can go negotiate. And, I think a lot of times everyone is like waiting for the crash or waiting for this. And, you don't want to miss out, right? Because when you have a lot of inventory, you have a lot of power as a buyer, because like there are 5 places for sale where I want to buy.
And that's the point.
And there's probably 3 or 4 that I actually want. I can go to them and say, listen, if you don't take this deal, I'm going to present this to the other 3 people in the neighborhood, right? And they're not having all of this deal flow right now. So I have a lot of power, but that doesn't mean I'm just going to sit there and wait for prices to just crash, because to your point, if they lower interest rates, there's a zillion other buyers that now can afford that monthly payment. And those houses are going to sell or even increase in price.
Right. And it's the same thing on the rental market too, guys. Like, as you guys know, we're actively buying. We just put another deal in escrow in North Scottsdale. We're excited about that. We're going to close on that at the end of next month. We bought that big one in Las Vegas. We bought another one in Phoenix. We got a 312 unit that we're building right now. It's under construction. We're going to break ground on in Tucson in the next 60 days. So we are super active. But I will tell you, our acquisition guys, we had a call 2 days ago, and they went out and looked at some properties in downtown Phoenix. And guess what the concessions are? A concession is like for a renter. They're trying to attract renters. Guess what the concession was on a 12-month lease?
2 months?
4.
Wow.
So you imagine this. This is downtown Phoenix right now. So this was this week. So our acquisition guy went down there, and we went to the website while we were on our investment committee call. And I looked at the property, and I'm like, holy cow. They're doing 4 months free on a 12-month lease. Okay, So that should be a tap on the shoulder. That means there's too many units in that particular submarket. Same thing in the West Valley of Phoenix. So now, why am I talking about these two things? Because all you got to do is drive over to Tempe. All you got to do is drive over to Scottsdale or some of these other areas, and you're at 95, 96% occupied and no concessions. Mm-hmm. So, and these are 5-10 miles apart. And so when you start to take a look at, these things, you have to look at them on a submarket basis. But the problem with 4 months free, even if you can't buy that, because then it goes to 3 months free, which is still bad. Then it goes to 2 months free, which is still bad. Then it goes to 1 month. Then it goes to half off. Then it goes to 100 off. By the time you get back to that, it just needs a lot more people. So what you have is a lot more inventory. And so inventory makes pricing go down. So essentially what that means is that rents are not at all, not even close to what they're trying to say that they are. If you're doing 4 months free on a 12-month lease, your rents are, 8 months of 12 instead of, right? You have to back that out. That's basically lower rent. Same thing with houses. As you start to see these clusters, these are going to be opportunities. It might be temporary. It might be permanent. Maybe there's more. I don't know. But when you start to see 5 houses in a particular neighborhood that Danille's been looking at for 4 or 5 years and hasn't been able to buy anything, you all of a sudden have negotiation power. And this is kind of the point. Mm-hmm. So you go in and you get a fixed rate debt. It cash flows, by the way, based on the rents in that particular market, even at today's high interest rates. So you do a fixed rate debt. Then what you do is if rates go down, you finance on the way down, but you're hedged on the way up and you cash flow either way. And that is the way you find good deals. And so while there's this disruption, while you're starting to see more supply, while you're starting to see more days on market, while you're starting to see people like what we saw who drop their prices, to try to sell a home, you can take advantage of that. We've had numerous people come to our house and say, this was an incredible buy. And they can't even believe that we bought it for the price that we bought it for. And by the way, while interest rates were high.
But I do want to make a point on our house and just on other things is, a lot of people are seeing these price cuts and they're like, oh my God, like everything's crashing because you have price cuts here and price cuts there. But people are overlisting their homes. Yeah, like our seller, when he started, he overlisted the home. Started too high.
Fair point.
So you see these cuts and it's like, and we did get a good deal, but I'm just saying like, you have to look at that, right? So just because you're seeing homes in your neighborhood cut prices doesn't mean that the market's crashing. Like people say, oh my God, prices are crashing 10% because my neighbor has lowered their house 10% and it's still not selling. It's like, yeah, but what did your neighbor list it at? Because a seller can list it at whatever price they want. And that price could be too high for the market. Like if things never were selling for that, it's not really lowering the price.
Right. Well, we did it on our land.
Yeah.
So like we listed some land because we were going to build, and I'm like, well, let's take a flyer on it. Let's just see. Maybe somebody bites at a higher price.
Right.
We knew at the time we were going to list it above what everybody said, about $500,000 more, right, for this land, right?
Yep.
And it listed for, 6 months. And we had some offers here or there, but they were lower, et cetera. So we lowered it to a price that it'll probably sell at, right?
Yeah.
Based on today's number. But we did it intentionally, and it's exactly what the guy did on the house that we bought. And there's nothing wrong with trying to put it out there and test the market, because you never know. Somebody might have come by and bought that thing.
Especially a lot of times people aren't necessarily in a hurry to sell. And this is a big difference between 08. 08, people had to sell. They were trying to get out of their mortgage before they were underwater. And that created a rush of sellers. Right now, I'm listing a property. If it sells, it sells. If it doesn't, it doesn't. I think a lot of people have that laissez-faire attitude because they have a low rate. They could stay and just live in it. They would like to upgrade, but if it doesn't sell for what they want it to sell for, they'll just hang on to it. Or maybe it's a rental, it cash flows, doesn't cash flow as much as they want it to, would like to turn it into something else. But if it doesn't sell, it doesn't sell. There's not a lot of urgency with sellers to sell. And I think that that's like a big difference too. Like they want to sell, they give concessions to sell, might lower the price a little bit to sell, but they're not going to be in a big hurry.
Well, I think that's kind of the point. When you're at the in any kind of a bubble, and prices have gone up next year, like you're kind of been used to that. We've been on this ladder. Everybody keeps climbing the ladder. Land's gone up. Homes have gone up. Everything's gone up. You're going to kind of push the envelope to see if you can get something. If you don't have to sell, and that was certainly the case with the person we bought the house from. It's certainly the case on the land because we don't own anything. We don't owe anything on the land. And so I'm like, we might as well just see if we can get another $500,000 out of this land. It's worth a 6-month experiment, right? But the reality is that really a price cut?
Exactly.
I mean, that's actually the point.
Right. And Michael Shane says, people like to take 1 or 2 listings as evidence of a greater macroeconomic issue and ignore things like the Fred chart that you guys shared. Yeah. And I think that's important because, you see the headlines on YouTube, you see it's crashing. You, like Michael said, you look at a few listings that have went down in price, but you're not looking at this greater macroeconomic chart, right? Like, per square foot, prices are up 1.2% from last year. Yep. Prices overall are only down 0.8%, and that's skewed because of the size of the home. So if you're looking at that, like, it's really flat, if nothing else, And so you can't, for a crash, you need lower prices. For a crash, you need an excess of inventory. For a crash, you need sellers motivated. Like, you need all of these things. And so people that are just reading the headlines of, I'm not going to buy right now, I'm just going to wait for it to crash. Like, you are going to be waiting because the truth is that if they lower interest rates, people solve to their monthly payment. Most people do. Every half a point, quarter point they lower, more buyers come into the market and eat up some of that inventory. And that's probably what we've seen from the housing inventory in November to the housing inventory now. It's went down a little bit, right? Because interest rates are down.
And let's not forget about the consumer. So I think it's worth noting the person that's, let's say your tenant, or maybe you are a tenant. Right now is a really good time for you because there's all these options, right? And we're starting to see that. We're starting to see, especially in areas that got bubbled, but with Airbnbs, they're breaking down and going onto the market in the form of listings, right? People are trying to move those, and we are seeing a little bit of a retraction on the economy right now. Mm-hmm. And so certainly that's happening with rents. And so when you have a market like in downtown Phoenix, it's 4 months free, as an example. It's a tenant's market. And so that's good. That is a good time to buy. Now, if you fast forward 18 months from now, guess what? It's a different market because more than likely, a lot of those units are going to be absorbed. Maybe not in the West Valley, maybe not in downtown Phoenix, maybe not in a market near you where there's been a lot of inventory, but it might take longer. But there's the word, what we call absorption. How long will all those units absorb? Whether it's a tenant or whether it's a buyer, it doesn't really matter. But when there's a smattering of units that are added into a certain block, like that Airbnb issue down in Destin, Florida, mm-hmm. where the guy had, there's an actual Airbnb community of single family homes somebody built, which is actually a great idea during the time. But now, last we looked, I don't know, there's maybe 150 homes in there, or there's like 30 for sale or something, right? All almost the same floor plan, right? So you're going to have a problem in a market like that. So there's an absorption that eventually a price point where people will come in and they'll take those off your hands. Those are going to be isolated, and they have been isolated situations. Isolated markets, isolated submarkets, because as you guys know, things can change dramatically from submarket to submarket, and so that is the beauty of real estate, in my opinion, is to be able to find out, what risks are you willing to take in a disrupted market. And, where is that market headed right now? And because if people are going to move to Phoenix, let's say, they have a lot of choices. And so, where are they going to go? It's going to be based on, obviously, more than likely, employment would be one of the big drivers. And so those are things that you can do to kind of piece together where you want to be. And so as long as you pay attention to those things, I think you're going to be just fine. This market, we're in the process of, we're just literally right before this YouTube, I was talking with our acquisition guy about the rate lock on our deal that we're buying. We're going to settle in at about a 5.5% interest rate on a $97 million purchase. That's pretty good. Now our loan to value is in the 60 range, so that is actually kind of conservative from a lender standpoint traditionally. However, which means 40% down. But the reality is, we think we're going to get full term IO, which is interest only. That means interest only debt at 5.5% at like 60% loan to value. That is excellent money right now, guys. I'm telling you, you can't borrow at much better than that. And so for me, historically, yes, we've been in the 3s. Yes, we've been in the 4s. But I've also been in the 6s and the 7s. And as high as 8 and 9 even in some cases over the years. And so 5.5 is a good number. If you take a look at historical averages, your interest rates, even on these homes, are not that far out of whack. It's just that all of us have been super spoiled in the last 10 years of having these extremely low interest rates as a result of the bubble pop from the great financial crisis, which was, as we know, in 08, 09. And so what we just kind of got out of was just absorbing all that excess inventory.
Yeah, right now rates are at 6.6%, and that's down from 6.9% last year. So, I mean, they are slowly, coming down. I mean, not as fast as people would like, but they are kind of coming down. And I also wanted to just touch on, all these foreclosures people are talking about, the amount of foreclosures or that loans not being paid. We're not really seeing that in the, regular loan market.
Nope.
It's mainly in the VA and the FHA loan market. We're seeing an increase in, loans that are behind and delinquent.
Still historical lows, though.
Still historical lows. And also,
if you guys got to be careful if somebody says like, February was worse than January. It doesn't mean that it's going the wrong direction.
Well, even if they say they're up 20%, if they were low to begin with, being up 20% is still low.
Yeah.
They're not saying how much they are compared to pre-pandemic levels.
Correct.
They're trying to get those headlines. So you have to really look at that because, and also, you have to think FHA loans are probably the riskiest loan. People that are getting FHA, those are more of the riskier loans to do, which is why they're not conventional loans, right? So the fact that those people are getting squeezed on taxes and insurance, like that's not super surprising that they're behind. You actually have conventional loans in a better place than they were this time last year. You have less people that are delinquent there.
Yeah. That's a good point. But I think it's not a problem. Like, I was, everybody needs to be reminded that, Obama inherited a mess. Like, I think he came into office like 2009, I think it was. Like, you imagine, like, the great financial crisis started in 07,
Actually, I think it was 08.
Was it? Okay. Yeah, he was elected in 08 and inaugurated in 09. But good point. There were 500 banks that went down in 08. 500 in 08. Okay, now, and there were like 6 million homes went into foreclosure. Okay, that was a problem, all right? And so what happened? He created programs to try to keep people in their homes, and he was kind of unwinding this whole thing that had actually started from Clinton when, during the Everybody Needs to Own a Home program that he pushed, and then Bush kind of continued. And so Obama got the brunt of it. And why do I bring all this up? That's foreclosure. Like, that was over 6 million. I think there were 6 million people that were in foreclosure, and 3.2 lost their homes. It was in the 9 million range. Okay, this is nothing compared to, and we're much bigger population now. This is nothing. These are small little things. The government, especially, I think that we have an affordability problem. That's the problem. And they're going to do everything they can. There's always foreclosures, guys. There always will be. There's always going to be defaults. It doesn't matter on what. I have people that don't pay rent when they move in. We have people that buy a car and can't own the car, and then they get repossessed. There's always going to be that. And so there's always going to be a percentage, but we're not out of whack by any stretch of the mean.
It is a number, though, that you do want to pay attention to, right?
Sure.
I mean, if it would to start to get out of whack, but we're just, as of right now, it's just not flashing any red lights.
Not a problem.
Yeah.
I mean, these people, a lot of these people have a tremendous amount of equity, right? Home prices went up a lot, and people are afraid of that. But the reality is be careful what you're afraid of, right? Like you don't want deflation, right? You don't want home prices to go down. Although people, to buy they do,
right?
But if you own, you don't.
I know that's just such a dichotomy. You always want prices to go down until you buy, and then you don't want them to go down anymore.
Yeah, there you go. Great. So take a look at that, guys. Like, look how low we are. Like, can you go up just a little bit there, Jerry? So like, look at the foreclosure numbers up in the 07, 08, 09 range. That's what we just went through. Those are foreclosure problems. And, where we are now is not, it's way below, like this, way under the 100,000 mark, as you can see. And you go way back to 05. So I guess it kind of crossed under the line about 17, and it stayed there. So, and partially because of these low rates. And so we're always going to have there's always going to be a little bit, but it's not at all a problem.
Yeah. I guess, we're just trying to give you a really broad picture of the housing market right now, kind of what we were seeing, what we're looking at, what we're watching. And I know it's not these flashy headlines like it's a crash, it's this, it's that, but it's just not right now.
There isn't a crash.
It's just not right now. And just don't be that person sitting on the sidelines waiting for the perfect time to buy. Now is very good
Telling
time.
you guys, we're going into a renter market. We have an affordability problem. People are getting squeezed. Inflation's been a problem. I was talking to my partner yesterday about costs just in our own company. Like, everything's up. Like, the question really you should be asking yourself is, do you think things are going to be more affordable in the next few years? Mm-hmm. And if the answer is no, then and you follow the math, you're gonna see that we are going to be in a shortage very soon. Of new construction has not kept up with the renter market, and I'm telling you, in a year and a half to 2 years, they're going to be banging on the landlords again for rent control and all that kind of stuff because we're not going to have the inventory to keep up with the absorption. So right now, during this disruption, is the time. This is the time if you're investing because people aren't able to buy houses. The listings and the low listings is actually helping you if you're if you're trying to have a renter, and people are being pushed into the rental market, and it's going to get fully absorbed before you know it, and you're going to start to see rents take off again, and that's why I think it's a good time to buy.
Awesome. Well, we will see you guys next week.